And welcome to the rate update with Dan Frio. I am Dan Frio, and this is your opening bell to real estate and mortgages. So what we want to do today is I'm going to lay out a new format on my videos. We're going to talk about the news, updated news that should affect or will affect the markets in regards to real estate and rates. Then we're going to go over rates, and then I'm going to caption to tell you or let you know what videos coming up later in the day that you might find interesting. So let's get to it. The buzzword all around town is the sparking of a recession. So let's look at the headline news, and then we're going to define what is a recession. So the 30-year or the 5-year and the 30-year treasuries invert for the first time since 2006, fueling recession fears. That is CNBC. Let's go to the next one. Market Watch. Weekend reads. The slowing housing market and inverted yield curve signals a coming recession. So what exactly is a recession? Well, we go over to here. Let's go to Investopedia. What is their take on the definition of a recession? Well, they have a new verbiage on it. And let's go down through here and see what they're saying. The NBER defines a recession as a significant decline in economic activities spreading across the economy, lasting more than a few months, normally visible in real GDP, real income, employment, industrial production, and wholesale sales. Let's just check one other place. This one is just a headline that I got somewhere. What is the recession? How economics defines it. So a recession is a period of declining in general economic activities, typically defined when the economy experiences a decrease in its gross domestic production for 2 consecutive quarters. Other recession indicators include increased unemployment, falling retail sales, slowing manufactured growth, and a decline in real personal income. So let's dissect those, just those alone, to look at those numbers and see where we are. So the first thing we want to talk about is gross domestic products. Well, those numbers are going to be out later today, but we're not seeing a decline in the gross domestic production that I would significantly say we're going to see a recession because of that. But we're going to watch all these indicators throughout the week because we have, as I'm going to show you in the economic calendar, all this stuff is piecing together this week. So we'll be able to, by the end of the week, say, is there a recession coming or maybe not? So let's go through the rest of this. Includes rising unemployment. We don't see that. Actually, we're seeing much to the other way. There is massive job openings and just not enough people to fill those jobs. Falling retail sales. We need them. That's part of what's fueling the inflation fears. So then we go to slowing manufactured growth. Not seeing that. And a decline in real personal income. Well, I'm not really seeing that. Actually, the last few numbers that came out for the last couple months has income rising. You might feel otherwise, like, hey man, my money's not going as far as it should or could. Well, that's called inflation. The next piece of it is the inverted yield curve. So let's look at the yield curve right now to see if you think this is inverted. So this goes through March of 2022, and it goes like this. Well, a normal yield curve goes like this. Okay, so are we inverted? Not that I'm seeing. What will happen first is you'll start seeing a flattening of the yield curve. Okay, and then it'll invert, meaning it'll go this way. Okay, I don't see that. Okay, so now off to the economic calendar for the week. So let's see if any of this information that they basically were saying a recession includes is laying out this week. And then we're going to follow this throughout the week. So we have consumer confidence, which came in previously at 110. They're expecting 107, so a slight decline. We have the JOLT index. This is the number of job openings, how many openings there are. Well, the last read was 11.2 million job openings. Okay, so there's more job openings than people looking for jobs. So the unemployment rates can't be getting worse. Then we go down to non-farm payroll changes. We're going to monitor those. GDP came in previously at 7%. They're expecting 7%. So if the GDP doesn't go down and job growth doesn't start to stagnate, those are two pieces of the recession puzzle that aren't falling into place. The crude oil inventories, we're going to probably see a depletion in that again as well because of the need for fuel right now, especially with the Russian situation going on. Then on Thursday, we have initial jobless claims. That'll give us the read on there. Then we have Friday non-farm payroll, unemployment rate, and manufacturing, the PMI. So this week is full of information that is going to let us know is a recession on its way. Interest rates. Where are we for the day? So we start out that day on with the MBS market. Why do we follow this market? Okay, so basically what this number is telling us right here, and why do we follow it? MBS means mortgage-backed security. It's a bond that trades on Wall Street that is the biggest factor of your mortgage rate. Okay, so it's a bond that determines the biggest piece of that rate. So let's look over here. We're going to see the price right now is up. So what happens when the price of this bond goes up? It drives down yields. And in this case, because it's a mortgage bond, it's driving down mortgage rates. So that's what we see, but it's been basically a debacle for the past several weeks, and we're hitting highs on a daily basis. And you can see the chart right here. All right, so that's what's going on with the MBS market. So let's go over to where mortgage rates are. Well, this is the rates that are published by Mortgage News Daily on a daily basis to give us the average mortgage rates throughout the United States. So we go across here and we did hit the 5% trigger. But you're going to say, Dan, were you drinking this morning? Well, no, and I'll explain it to you. Rates right now on the 30-year fix is 4.95, up a quarter, but it's coming in with 0.4 in points. So what this is telling you is it's going to cost you 0.4 in points to buy down the rate to 4.95. The rest of these, we have the 15-year fix coming in at 4.22, up an eighth, or up 0.15. That we call that 15 basis points, and it is right here. We got the 30-year FHA/VA, the government loans, coming in at 4.45, up 7 basis points. The 30-year jumbos up 10 basis points, coming in at 410 or 420. And then we have the 5-year ARM that's actually taken a move to the other way. It's been going down and down and down recently, but we're up 10 basis points to 395. The spread has gotten even worse, so we're going to start talking about ARMs a little bit more, maybe to make the pain of these rate increases a little less for you. And we're going to talk about that later today in an episode that I bring out probably about 3 or 4 o'clock this afternoon. To conclude this, my name is Dan Frio. If you like what I do and all the stuff that I present to you on a daily basis, you find value, please don't forget to give me a thumbs up, subscribe down below, hit the bell every time I post a video, you get an alert. We just added some new features to the website, and right here. You can now chat with us online. If you have a specific question, you're like, hey, let me just ask online, chat away. It's usually me or Alan Platt. He's my vice president of sales. He'll be answering all these questions. But if you want to schedule a meeting to talk to somebody, please, you can do that over here, or give us a phone call at 844-775-5626. Thanks so much for watching. I'll see you this afternoon with my ARM video.